biology in terms of both ingredient sales and also developing its own branded consumer products. John, I think for the most part, many people on the line are familiar with Amyris, but just for those who are less familiar with synthetic biology, can you just give a very quick high-level pitch on what Amyris does?
Sure, and great to be on with you, Lawrence. Thank you for hosting us. So Amyris is a synthetic biology company. What that means, and for our company specifically, we are one of the world leaders in genetic engineering of organisms, in our case, yeast and other organisms, but yeast is our primary workhorse. And we engineer yeast that in a fermentation process that we've developed and operate at large industrial scale, we're able to convert cheap carbon, sustainable carbon from sugarcane into specific chemistry that we produce then for ingredients and molecules in general. And the way we like to think about it is we are remaking all of our chemistry, or a lot of our chemistry in the world today, using synthetic biology to make it sustainable, to make it high purity and better performing, and to provide a competitive cost and more access to some of the world's rarest chemistry from plants and animals.
Okay, great. And Amyris has been doing this for a long time. What have you learned in terms of what types of chemicals make for the best targets, both for ingredient production and then also for your own vertical integration strategy?
Well, first and most importantly, one that has a clear market with a customer that's willing and ready to pay you, so you don't get stuck with technology that you can't monetize. That's kind of like big target one. Big target two is chemistry that is currently facing a supply chain problem, because reality is you want to really use the technology to solve problems. And then thirdly, chemistry that is currently in high demand or need to be made in a sustainable way. I mean, the best example is there's a lot of natural ingredients in the world. I think if you use vanillin as one example, where the vanillin price, natural vanillin from Madagascar, became so volatile in the last 4 or 5 years that everybody started to chase a better source of vanillin. And so we actually developed a sustainable source of making natural vanillin to replace the natural source that comes out of Madagascar. I think today we're probably the largest single producer of natural vanillin in the world. And what we're seeing because of the crude oil prices is obviously a shift, because there's an opportunity to now trade up from a crude oil or a synthetic source of vanillin to a natural source that's sustainably produced. So that's a perfect example of a great molecule. Clear market, a clear customer, in our case, somebody who paid us to do it, a technology opportunity where you can actually make vanillin as good or better than it comes from the natural source, but make it sustainably.
And in terms of the market structure, as you know, Amyris has been flexible between just outright sale of the technology platform, partnerships and licensing, or producing yourselves and then launching your own brands. Can you talk a little bit about what types of market structure you look for to tilt which way you monetize or you capture the value of the molecules that you produce?
Yeah, I like Jeff Bezos' comment about what markets to go chase, and I think his framework is really simple: go where the margin is. I think his frame is wherever there's a lot of margin is actually a great market opportunity. So I think of value chain and total available margin is how I think about then how to choose the participation strategy. So where you participate is where there's the greatest value and the least barrier to entry. And in those markets, we really, and obviously where we have a technology advantage, those markets, we want to get as much of the value chain as possible. So beauty, personal care, consumer brands, okay? And then you kind of come all the way back to, very complicated, hugely competitive, and somewhat controlled value chains. I think of vitamin E as a perfect example where we have a great technology. I mean, I think today our technology is responsible for probably 25% of the world's supply of vitamin E. But it wasn't really best suited in our hands. So we actually were able to license the technology and gain a lot of cash up front and then some long-term value by transferring, in this particular case, not the entire technology, but purely a license for one of our molecules in a specific market that was vitamin E. So that's kind of like the two extremes. A lot of margin, not very competitive, super advantaged technology, beauty. We want to play all the way in the value chain. Advantage technology, very complicated value chain, actually, in the hands of a few people in the world, where frankly, they're much better suited to play in that market than we are trying to take share away from them. License, brand.
And I think like 10 years ago, I think the perception was mostly a matter of basically pushing molecules into the market. How much market pull do you see in terms of, if you think about your pipeline of molecules you want to launch this year, or however you want to frame it, how much of that is research projects that other people came to you and said, we know what we want, or we know the functionality we want, and then you went off and found the solution, but you collaborate, you basically were outsource R&D for them, and then you commercialize it?
Yeah, another great question, Lawrence. And I would reframe slightly in that market pull, or having a market that has a structure that you could see demand, versus market push. You kind of have a great idea, you want to develop something, and you hope like hell somebody buys it. Okay, if you think about the two, we continue to be significantly driven by market pull, but the way the market pull is occurring for us has really shifted dramatically at our choice, right? If you think about the early days that you're referring to, and really for the molecules that we expanded in starting in around 2011, 2012, right? We really focused on having a partner signed up because we had a tremendous amount of bad experience chasing markets, developing molecules, and then figuring out we got it wrong. We picked the wrong molecule. We didn't understand market structure. There's just a lot of things we got wrong. So we kind of went to the extreme of, we're not going to engineer something unless a partner comes to us and actually gives us a long-term contract and has very clear milestones for how we get there. Okay, that was the first phase, market pull. We're still doing market pull, except that we are the ones picking the molecules and we own the molecules. We're not giving up control of the molecule in the go-to-market. So you might say, well, how's that market pull? Well, we're still going after markets that are short, are significantly volatile, and have a clear need where we know we have a molecule that there's a great market pull for. It's just that it might be our brands, or it might be our B2B channel that sells it, rather than us, licensing it to a DSM or a Givaudan or a Firmenich or an Ingredient. So that's the difference. It's still market pull. It's just that we're keeping the technology versus licensing it in exchange for, an upfront committed contract for the long-term demand of that molecule.
And you alluded earlier to technology advantage, and I think you've often said you want Amyris to stay on the cutting edge of biotech in terms of the tools that you're using. Can you talk a little bit about what that means in terms of both R&D spend and the capital intensity of your efforts? Because often you're the ones learning how to do things the right way. There is nobody to copy or nobody to learn from. So can you just walk through a little bit what staying at the front end gives you, and then what the kind of cost of doing that is?
Yeah, absolutely. And look, I think there's two sides of technology advantage. I'll talk to what I was referring to, and then I'll answer the question you're asking, because there's actually two dimensions of technology advantage. What I was referring to in technology advantage is advantaged chemistry, right? A chemistry that has less or different impurities that makes it easier to plug in to whatever the end application is. And there's a lot we can talk about there, but that's what I was referring to. And I really believe today, and I've said this for the last 15 years, right? If it's not no compromise, in other words, if the technology, or in this case, the chemistry isn't advantaged and it's sustainable at a competitive price, the odds of you really getting a ramp that makes sense for a business that's scaling are not very high, right? So this no compromise and technology advantage was what I was referring to. Our chemistry for every molecule we produce today from fermentation is advantaged to the alternative source. And it's advantage in almost every critical performance attribute because that's how we target. We work hard at understanding what is the advantage the consumer or the customer in the B2B sense is looking for, and how can we engineer that into the microbe to then convert it effectively for the end market. Your aspect, the technology advantage is really the how we're doing the engineering and the advantage we have there. Look, I have to say, I wish we could be more advantaged. Like what? Because like what is the perfect scenario? The perfect scenario is you engineer once and you hit the target. And by the target, I don't mean the chemistry. Like I've said this several times in the last 5 or 6 years. Our ability to engineer an organism to make target chemistry, it's unbelievable. We can make just about any chemistry in a month or less by engineering the bug. That's not what I mean by target. That's kind of like one small component of target. By target, I mean at a cost that's competitively advantaged in the market. And that's actually what takes the iterations and generations of engineering. And that's when I think about technology advantage, we are constantly seeking to make the platform better, faster, cheaper at getting to target economics, target chemical profile for that molecule. We are today the most advantaged in the world. And my measure is simple. It's how fast can we go from target to a molecule that's scaled, producing the right chemistry at the right cost. And now we're really, for the majority of our pipeline, a year or less in our ability to do that. There are still some outliers. Some chemistry is more complicated. Some cost targets are more challenging. But that's where we are. And you don't have to believe me. Just look at our last 3 molecule scale-ups, right? The last 3 we did were all a year or less, with the record being what we did for squalene directly made from fermentation, which was an amazing project, 9 months from target to large scale-up. And I think that's where we want to be. That's how I assess technology advantage. To deliver on that, we've invested just consistently, almost without fail, regardless of how challenged our capital structure was, or regardless of how desperate I was for, the next investment to make sure I could make payroll. Okay. Like no matter where we were, it was 70 million a year without fail in the technology platform. And we're still there. A lot of people don't realize that, like, the investment in technology has nothing to do in the products we sell day to day. If I separated the business and looked at the products we sell day to day and their ability to generate a profitable business, we'd be profitable today without a doubt. So where does the cash go? It goes into continuous investment in the platform, and then the investment you make in scaling up, because that obviously takes a lot of cash to do also. So I hope that helps. And like, if you were to ask me again, where do I see the next step? Look, I think the next step is in getting better and better at the linkage of downstream to upstream, meaning how well the engineering solves for getting more of the chemistry in the bug versus downstream process. I think that's really the next big leg, because, and I said this recently, it's actually interesting. Half the complexity in scale up is actually downstream. And what is downstream? It's purifying. It's sometimes it's hydrating the chemistry. It's doing a hydrogenation step or a polishing step, because you want the chemistry to hit a certain profile, right? So again, I hope that helps. 70 million a year since 2011 without fail. We're still doing it this year. And this year it's a little more because we're now in the next generation of the platform, right? We think there's another step change really in using AI and data more powerfully based on the amount of data we've collected over the last decade.
So there's a few things I'd like to unpack there. The first one is, as you think about sort of the margin structure of the launched platforms, I think the general framework has been 40-50% targets for the industrial, the ingredients business, 60% plus for the consumer products. Are those platforms on a standalone basis operating at that rhythm, or are there issues that are currently sort of marring the results, and it would take and then how should we think about the path to those kinds of operating rates just at the actual commercial side of the business?
Yeah, let's kind of go into the detail there. Look, on consumer, not a problem, right? As a matter of fact, consumer is expanding, right? Because we're bringing more of the consumer in-house. We're attacking some of the packaging costs, and then by the end of this year, I hope to have fulfillment, pick, pack, and ship. Also, something that we have more in our control, right? So you'll see those activities expand the gross margin in consumer, and the consumer gross margin is like a machine. Like you take our ingredient, you formulate it, you pack it, and you deliver that kind of gross margin day in and day out. And the big drivers or change of gross margin there, other than the improvements I just talked about, are more the mix between our direct to consumer and what I'll call the wholesale, selling into retailers, right? How that mix shifts moves the margin slightly quarter on quarter, but we've been almost like a machine, 63% gross margin. And again, I think you'll see it expand a bit as we make these moves. Look, I think the second bucket is the ingredients in the pure sense that you talked about, which are ingredients that we control in our portfolio, and we sell B2B. We sell to other customers, and those are also structurally at about the 40% level. There is a bit of an issue in the short term, which is like we're now completely out of capacity, and every kilo of production we add in Spain or somewhere else that's not our plant is super expensive right now, especially in Spain because of energy prices going up as a result of the war in Ukraine, right? So I'd say the second bucket, structurally sound, short-term noise, mainly because of the temporary impact, energy costs, and the fact that we don't have control in our plant. It's interesting. If we were producing in our plant in the Baja Bonita facility, which is starting up in a few weeks, if we were actually producing there, the war would not be impacting our cost of goods. So that just kind of gives you a sense of how structural the cost of goods is. I think there's a third bucket, and the third bucket is fairly new, Lawrence. We actually haven't talked about this a lot. It's that we now have a bucket of ingredients, right? It's pretty significant that we've done more of a partnership on, right? This is the deal we did with DSM and the deal with Ingredion. Like between RebM and the F&F ingredients, that's a good chunk of units in our portfolio, especially on the ingredient side in the short term. That's also structural, but it's a lot lower margin because really what we did there is we traded the long-term margin up front, including what's coming, the next few years in the earnout, in exchange for kind of like a cost plus deal. So we remain the manufacturer. We have the unit load for utilization of the factories, but we don't get the upside in the value share that would give us the long-term margin structure of those molecules, right? So I just want to call out that we now have a slightly different portfolio, which is why in our last guidance, we kind of said ingredient gross margin long-term, 30 to 40%, not, that 40% range we've been talking about. And the driver of that change in range is because now there's a piece in the mix that's a lower margin profile based on what we did in these deals. So I hope that helps. 3 categories, 2 superstructural, 1 changed. The long-term structure sound, but it does change the range we put out there for ingredient margins.
And then just to remind people that for those deals, the kind of overall return on capital or return on initial capital invested, however you want to frame it, I think you had said at one point it was 10 times the total capital invested up to the point of producing the assets. That was kind of the upfront payment.
That's exactly right. If you think about it, I don't have the exact number in mind, but yeah, when you look at the earnout and the upfront cash, we ended up monetizing around, or said differently, capturing about 600 million in payments from these deals. And I can tell you now that we're in the first year of the earnout that this is actually an update from what I had said earlier. We're actually earning on the top end of the range. We started the year thinking the earnout would be around midpoint from what we thought. And actually, really as a result of crude oil pricing and people wanting to shift faster than any of us thought away from ingredients that are the derivatives of crude oil, demand for a couple of the earnout ingredients has skyrocketed beyond what we expected. So the earnout's actually going to be in the high end of the range, which means, again, over 600 million in payments compared to what we invested out of pocket for those ingredients, which puts us at about a 10x return for the capital we put in for those ingredients. I think a lot of times, people look at that and say, well, holy shit, how about all the rest of the money you invested? Remember, the big investment we made wasn't in those ingredients, because those ingredients were actually mostly paid for by partners with little investment out of our pocket, with the exception of RebM. Most of the money we've invested was the platform and a focus on Farnesene. So you might say, well, why? Why put all that money there? Because Farnesene enabled us to really build out the platform. It's almost like, we picked the hardest molecule to engineer for a market that was actually impossible to get to at a price point that built a sustainable business, renewable diesel with Farnesene. But the benefit of that was, even though we put a lot of money into it, on Farnesene licenses alone, which are not included in the 600 million of cash I just referred to, Farnesene licenses alone, between fuel and vitamin E, we've gotten back about 550 million, actually about 600 million, because of the most recent license for the Ambrox conversion, Farnesene, right? So think about that, 600 million back, but probably $1.5 billion investment in Farnesene, because Farnesene was the build out of the platform. But Farnesene is the molecule that just keeps on giving. I mean, we're not even near scratching the surface of the number of derivatives, because you got to think of Farnesene as the replacement for crude oil for many of the terpenes in the world, right? So, but anyway, I hope that helps. That the investment and the return on the 600 are based on the F&F ingredient portfolio. We actually put very little money out of our pockets, so it was easy to get a 10x return. And we have a lot more to get from those molecules and the way the deals were structured. And then there's Farnesene, big investment, not quite where we want to be return-wise yet, but still at the beginning of the monetization based on the derivatives in the end markets. And remember, we've only licensed 2 in markets today, actually 3. We've licensed vitamin E from Farnesene. We've licensed the Ambrox from Farnesene. And then we have the diesel molecule that's not exclusive. It's actually a non-exclusive license with exclusivity for the European market to Total. So we have a long ways to go for what Farnesene can do.
And so again, there's a couple of things to unpack, but one key question that keeps coming up is, how is it possible, at a very simple way, for you to keep coming up with molecules that are 40-50% cost advantaged? And so the way I've thought about it, and maybe correct me if I'm missing some major pieces here, is that you're mostly you're doing better when you target complex molecules made through dozens of chemical processing steps. The more complex the process, the more losses and inefficiencies along the way. And since you're doing a one-step process, is that the right way to think about where you've had the most success, or is there a different angle to it, where the biological organisms are just better on certain types of chemistries?
It's one of my favorite sayings, especially in some of the industries we play in now. It's like, it's the chemistry, stupid, right? And I think you hit it pretty well, Lawrence. It's sort of like there are multiple dimensions, but at the heart of it, you start with the chemical steps required from source chemistry to final molecule, right? And I mean, I'll use vitamin E because it's one of my favorite examples. It's an easy one, right? What are we doing in vitamin E with Farnesene? Well, we're actually replacing crude oil as a source of making isophytol. So how many steps does it take to go from crude oil to isophytol? It takes about 8 steps. So what did we do? By using Farnesene, we actually take out half the steps. We go from Farnesene to isophytol in 4 chemical steps versus 8 chemical steps. And it is really that simple. Like, okay, 4 additional chemical steps means that at the conversion of Farnesene to isophytol, the parity of crude oil to farnesene ends up being $30 a barrel. So that means everything above $30 a barrel, farnesene is advantaged to make isophytol. That's the kind of structural position that we like to be in, right? We like to understand source chemistry. We like to understand steps to final. And then we always start with, can we get the bug to make more of the chemistry? Because then it's purely mathematical. We know that we could get to where we need to go for a lower cost than the alternative. I would say, based on what we have in the pipeline, I would say over 90% of our pipeline continues to be at that 40 to 50% cost reduction to the alternative source in a normalized market. Like, there are points in time, like right now, where all of a sudden, it's not just 40 or 50%, but I don't like to plan on that, right? I like to go back, coming from my oil industry days, right? In the oil industry, we never looked at peak, we never looked at bottom. We always looked at, like, what is the midpoint and what do we think the long-term view of oil is, and let's make all of our capital decisions on that. We make all of our bioengineering decisions based on that same approach.
So now let's take it down to the kind of SG&A line. So you have a significant step up in SG&A. I guess back of the envelope looks like you'll be running north of 300 million this year, given where you were running in Q4. Is that the right way to think about kind of your spend? And how should we think about the incremental dollars spent and the time lag before that turns into sales? I know in the past, long time ago, before COVID, I'm dating myself, you talk about it like $1 of advertising or advertisement would be $3 of revenue once it had an effect. Is that the kind of framework that we should be thinking about, the step up in SG&A, or what's the algorithm there to justify the increased spend?
Yeah, no, look, great question. And let's really take out the noise first and then go right where you were, right? Because I think your framework is not too far off, Lawrence, as always, right? You seem to get the math in the ballpark most of the time. Look, the noise right now, and we're in the process of addressing that, is really a presentation issue. We've been capturing shipping costs, fulfillment costs, and some other variable costs for the consumer business in SG&A. And that's a problem, because the more revenue we drive, the more we ship to customers, the more SG&A goes up, right? And it is a big number. So what we want to do, and we're in the middle of actually working that through, is move all those variables connected to units that are shipped above line, put them in cost of goods. And that will actually give us a much cleaner way to look at the SG&A. So now, with that clean look, what does it look like? Well, it's pretty easy. It's not far from the framework you just described, okay? And the way I think about it is, we've been growing a lot, so there's new brands coming in which require new people, and then there is a percentage of revenue to investment in marketing that drives growth, right? So, I would tell you, for a brand new brand, it's probably less than 1-to-1. For every dollar you invest, you get $1 of revenue. Year one, that's usually even worse than that, right? But then for a good brand, I mean, look at Biossance, you can get $8 to $10 of revenue for every dollar invested, right? So, if you look at the industry is about 20 to 25% of revenue invested in marketing, and that's what I see our long-term sustainable model being at. Okay, so then how does that translate to leverage of the SG&A line based on where we are and what the pipeline looks like? Because obviously, the more mature brands we have at scale, the more we can absorb growth investment, because growth investment, even though it's a high ratio, small return, they're actually small dollar amounts. Okay, so here's how to think about that. By this fourth quarter, and I'll start with a further out number. Fourth quarter of 23 will be at a $1 billion annual run rate for our consumer business. Okay, so that's actually where I expect mature economics, which doesn't mean that we're not doing new anymore. It just means that the mass is so big that you can do new and absorb in the total. So at that level, then what do I expect the economics of the business to look like? Well, at that level, I expect us to be able to turn a 30% adjusted EBITDA on a regular basis for the company. And that's probably the best way to think about it, right? And then there's a bunch of stuff in the framework that falls there. So then come all the way back to today. At what point does OpEx level off? Do you get to a steady state where you realize maybe it'll increase some, but not at the rate we've been increasing, really by the end of this year? By the end of this year, and I said this publicly, that the fourth quarter is probably the first time where you start to see the earning power of the portfolio come through. Definitely not at target. Like, as I said, at target, I expect to be fourth quarter of 23, but starting to actually flow positive by the fourth quarter of this year. And then coming out of the fourth quarter of this year, I'd expect, again, obviously some movement, but much steadier than what you see really through the first half of this year. Because through the first half of this year, you're going to continue to see step up to the point of getting stable. You'll have a little bit in the third, and then the fourth pretty leveled off going into next year.
And the path to positive, I mean, showing that earnings power, that's really before even factoring in milestone payments, correct?
Yeah, no, good question. I want to separate the two. Fourth quarter steady this year does have, what'll be north of 40 million of a milestone payment. When I say milestone payment, earn-out payment, not milestone payment, but earn-out payment that's actually in the P&L in the fourth quarter. Okay, but you can separate, because, by the way, all that's going to do is balance out the ingredient portfolio in light of all the noise in ingredients this year. So if you take ingredients out and you look at consumer on a pure basis will be positive in the fourth quarter. So I'm really making two statements. In total, positive in the fourth quarter, but it's a bit of a mixed bag. Consumer, and by mixed bag, I mean the ingredient side will have the earn-out in there. In the consumer, it's going to be solid and positive, okay? And by solid, north of 100 million in revenue in a quarter, right? I think when you start to get to that level of turn, you start to get to a business that's really material that people 3 years ago didn't think we should be in.
So I'm getting a surprising number of questions, probably not surprising for you, but I guess it's on the cash flow needs in 2022, 2023. So it's one thing to get to adjusted EBITDA positive, but to get to actual free cash flow self-sustaining positive levels. What do you see as the path for, or the funding needs for the company before it gets to a completely self-sustaining kind of business model or scale?
Look, the two things that are missing in the comments I just made, obviously, are CapEx and working capital, okay? The CapEx is pretty well understood, because I'm in the middle of our last plant acquisition, which will take care of the consumer side. So I don't expect to put more money into consumer manufacturing for a while. And then for the fermentation side, we have a very clear view of what we need in fermentation capacity, and those projects are well underway, and we have cash on hand to fund them. Okay, so what that really says is getting to generating positive cash for our business and having the assets in place that give us capacity through the end of 23 is all with cash that we have on hand based on the current outlook, right? I don't want to be so cocky to think that in light of what we learned recently in the Ukraine, that the world's going to be steady state. But with what we know today, assuming there are no legs dropping ahead of us, we have the cash on hand to comfortably get through where we need to be to fund everything through the end of 23. And by everything, I mean the capital and working capital needs.
And to that point, it's funny. The other night, as I was preparing for this, I was thinking about the number of dramatic shifts in the macro or changes in trends or crises that we've seen since you started the company. And so, how much of a cushion do you feel is in the numbers? Like, what have you left out from the numbers that would possibly give you a bit of a cushion if the world changes direction again?
And without getting specific, I can kind of maybe, if this is not helpful, let me know, Lawrence. I'll take another stab at it. But the way to think about it is, and this is just looking historical and really having Hans help to look at how we plan going forward, and even more importantly, how we communicate with the market. We have a comfortable 30% or more cushion in what we've been saying publicly, right? And we're doing that for a lot of reasons. And I'm not going to get into the methodology and how we got to that third, but that might be the easiest way to explain it. When you look at what's out there, we've got about a third of cushion built into what's out there.
So, back in the biofuel days, I think if somebody had told you that people would be signing the kind of contracts that are now being given to the SAF players, I think you would have been jumping up and down at the podium. Um, is there an opportunity for you to go back to that? You may just not want to. I mean, I can understand that given what you went through, but is there an opportunity to go back and license some, the Farnesene technology into other parts of the biofuel market and address the SAF market?
Yeah, let me, and I think you, starting with all the movements, right? Think about it. When you and I met each other early on, when I came into this thing, I mean, I came into it because I was in oil and I really was passionate about sustainability, but also dealing with the scarcity of barrels, right? Kind of like the outlook was a scarcity outlook. And then all of a sudden, we have shale and we have new developments and we have higher oil prices that feed new investment. And all of a sudden we transition from scarcity to abundance. Talk about a monumental shift in what it means to a lot of markets like the ones we played in, right? So, and here we are now where, the one reservoir in the world or set of reservoirs that people thought would be pumping oil and gas for a long time to come, with a big question mark, like, are people going to buy it and what's going to happen to it, right? So I have no clue. I would tell you, if we stay in an environment where oil stays north of 100, look, we have the best jet fuel technology in the world, right? So am I interested in taking that technology, renewable jet fuel? Am I interested in taking that technology and monetizing it? I am. Would that mean that we put our own capital into building plants to make jet fuel? Absolutely not. At least while I'm running the company, right? And maybe it's because of scars, or maybe it's because, look, I've spent a little time in the industry, and it's an interesting industry any one day in time. But is it an industry that you actually can put capital in comfortably, especially at the cost of capital that, in a way, we still have exposure to, right? So I just think we need to be more prudent, which doesn't mean we shouldn't participate, but the participation is probably more of a pure technology play. Going back to where we started the conversation, there are markets where the supply chain is such that we're better to be a technology provider than we are to participate in the value chain.
Can you give an update on the human trials for the SARNA vaccine? And just sort of what we should think about in terms of the next couple of milestones?
Yeah, look, we have sign off on the trials, and I've been careful because it's not an area of expertise for me to really let Immunity Bio and Patrick really lead the way with his relationships in the African continent, and then obviously Idri on the technology side. I have been monitoring carefully, and I would expect by middle of this year for us to be at a point where we're transitioning from the conversation of will it work or not to starting to scale up for commercial sales. And when I say scale up, there isn't much to scale up because of the amount of investment that Immunity Bio has made in manufacturing, right? They now have enough manufacturing capacity in their portfolio to produce about 1 billion vaccines a year. So obviously we've made a big bet. We've made a big bet, meaning we on technology, them on manufacturing capacity, that we will be the default long-term RNA technology for delivery of RNA therapies, whether it's a COVID or SARS type vaccine, or whether it's some kind of oncology therapy that comes out of what's in our pipeline today.
And are there which molecule are you seeing the most demand for right now that you're having difficulty meeting demand?
Well, there's probably two big ones, right? Farnesene. I mean, we don't have any place where we can make another drop of farnesene, and what's really driving that is crude oil, right? I mean, crude oil, because the crude oil pricing, anything we had in our portfolio that can be made from farnesene as a derivative instead of crude oil, we have more orders than we can supply, and that is a major issue. And you know, it's not a simple matter of just getting more tanks. A lot of people say, "Oh, just go contract more tanks." It's not quite that simple because it's a pretty precise process that we use for fermentation. It's not just put it in ethanol tanks and make farnesene, right? So that's our number one pinch point. There are others. There are others in the portfolio. Hemisqualane, but that's also a farnesene derivative. And hemisqualane is really an outcome of the JVN success. The JVN hair brand is on fire right now. It's doing phenomenal across the hair category. We're probably more than 2x revenue than we expected from the brand. So we're just super pleased with it. But the other impact is exactly what our strategy was, which is make a great brand, transform how a formulation is done, in this case, hemisqualane instead of silicones, and then see the industry come to us. And that's exactly what's happening. The demand we have for hemisqualane now is beyond our wildest dreams. And the issue is we can't get access to enough farnesene. So we're going to keep the market tight really through the third quarter. I'd expect in the third quarter for us to get access to more farnesene, really out of Baja Bonita. And then out of that, I think you'll see a pretty significant jump in our ingredient shipments because of more access to farnesene. And that's probably the tightest squeeze. Everything else, you know, we're seeing more demand than we have capacity for, but it's not at the magnitude of the farnesene derivatives.
And I guess a few questions around monetization events. One is we think about kind of the pipeline or the library of molecules you have. Should we be expecting each year 1 to 3 smaller monetization events, 10 to 50 million, being achievable, but hard to plan for? Or how should we think about kind of what the latent value of that library really is?
It's probably slightly different than the shape you just described. So I think the answer is yes, and not that we're planning for it, right? So let me make it really clear. I'll assert what I've said publicly before. We don't have any major monetization event planned, and the numbers we've put out in public do not include any monetization opportunity. That said, we have inbound inquiries frequently, right? And based on the inbound inquiries, I think the shape of monetization events, well, first, I think they'll continue, but I just don't want to plan for them. I think the shape of them will be different than 2 or 3 small ones. I think what you'll see is 1 or 2 bigger ones, call them, medium size in light of the numbers you're talking about, more medium sized ones a year. Some years, maybe none. Some years, maybe 2, right? But that's what I would see. And, what does a medium size look like? Somewhere in the 100 to 200 million range, right? That's the kind of thing that you probably wouldn't be surprised if we did time to time based on the size of our pipeline.
And then the second angle on monetization events is, with the consumer brands, how do you think about when it becomes viable to think about monetizing them in terms of, like, obviously at the first part of the growth ramp, probably not. When it's a proof of concept, probably not. But there's a certain point where presumably established brand owners would like to have a faster growth brand with a sustainable profile. I mean, you're kind of in the sweet spot from that perspective. How should we think about a reasonable timeline for those kinds of monetization events to occur, if ever?
Yeah, look, we don't have any planned, and so the takeaway should be never. But I've learned a long time ago, never say never, right? So that said, what does the framework look like? And here's the way to think about it: uh, 50 million in revenue, either actual in year or proven run rate, like a full quarter where you can be confident at that level and the growth. You have an annualized 50 million or better. So 50 million run rate or actual or better with a 50% or better growth rate, with gross margins that are north of 50, preferably 60% or better, that makes it a highly valuable asset in the hands of major consumer companies who want to buy growth. Okay. Now, last year, I think we had one in that category, and we were hoping like hell the launches would work out. I'd say hoping inside, outside saying, oh, they're going to be good. Now, here's where we are today. We have 3 to 4 brands in our portfolio that currently are running exactly in that sweet spot. So I think now I look at it as, look, the portfolio is going to continue to be optimized, because it's not like, I mean, we have 8 active brands right now. By the end of this year, we'll have, more than 10. And then we've got 3 more in the pipeline for next year, right? So at what point do you say stop? And I don't think it's a stop thing as much as it is portfolio management, constantly looking at high grading the portfolio, which will inevitably result in some brand deals. What they are, when they happen, I don't know, and I can tell you there are none in the pipeline right now. But I've just given you the framework for how we think about it, and that framework is not me making it up. It's actually what's come inbound, and how the inbound and how conversations with investment banks that have been selling brands to some of the big companies. It's kind of like a collective view of what a framework looks like to think about optimal, or I shouldn't say optimal, but optimization entry point. The optimal point is when the growth rate starts to decline and you've hit a peak. And that optimal point is probably more in the 100 to 150 million revenue rate, not the 50. Okay.
Now, several people have picked up on, I guess, your LinkedIn advertisements for opening stores in a few different cities. So, can you just expand on what your own retail strategy might be?
Yeah. Look, our retail strategy is really, really simple. We're going to have a few stores. I would say probably no more than a handful. They're going to be in key markets where influencers and consumers have a great intersection, right? Where we can really move the consumer expectation up using our retail experience. So they're there for image, they're there for experience. I would call them showcases, and not really being, an active retail participant. That said, our first store is delivering an excellent conversion rate, 64% conversion rate early out of the gate, which is really, really good. And we see with traffic now, really a store that probably has the potential of an overall footprint of $1 million in revenue per 1,000 square feet of selling space. And we think that's a pretty good place to be. But just because we can do that doesn't mean we're all of a sudden going to go into retail, for a lot of reasons. I don't want to put capital there. Secondly, retail is actually a pretty intense model that's different than what we operate today. And thirdly, I have some of the leading retailers in the world that are our partners that I have a lot of respect for. So I'd much rather use their channel, market to drive consumers to their doors, and then maximize value for our model by focusing on direct to consumer as our way to market, and their stores as a way to enable consumers to buy where they are.
Speaking of disruptions, a couple of questions. One is on hemisqualane. Is the demand that you're seeing purely for your in-house brands? Are you now seeing the hair care brands, other hair care brands coming to you and buying through the ingredients channel because they want to substitute away from silicone?
Yeah, I can tell you my comments were not related to our brands, because obviously our brands are using it, but they're related to third parties. And it's interesting. Right when we started launching JVN, I was in a meeting with the CEO of Sephora North America, great guy, John Andre. And in my conversation with John Andre, he's like, John, you wouldn't believe it. In the last few days, we've had 7 of the brands inside of our stores call me and ask me where can they buy hemisqualane. So that just kind of tells you it's like, and it's all about, and like if you're an investor, all you have to do is do a Google search or ask Google to give you analytics on Google searches. And when you start to see one of our ingredients in the top 10, you can assume it's a leading indicator for volumes are going to drive or rise very dramatically for that ingredient. And that's really our focus. Like, why do you have a consumer business? Because we want our ingredients in the top 10. How do you get ingredients in the top 10? You get consumers to seek them out. When consumers seek them out, what happens? All consumer companies start to look at those being the ingredients they want to use in their portfolio. That's our business model in a nutshell.
And so coming back to the vaccine, for those who are less familiar with the vaccine market, can you give a sense of what if you don't invest in the downstream capacity, what your kind of royalty or licensing peak revenue might be? I mean, back of the envelope, a couple of 100 million, or could you do better than that?
I'll give you kind of a rule of thumb, okay? Because that's probably the best way to give it. And, the rule of thumb has a lot of assumptions, and probably the biggest assumption that, we have validation because we have our first demand agreement for the vaccine, assuming it passes trials. So we have validation in what we think we're going to sell it at. But I can't tell you that that's going to be the clearing price around the world. I just don't know, right? It's a moving target, and it's hard to say. So, but based on what we know today and our best view, you could count on Amyris taking to the bottom line somewhere around $3 a shot, based on not being big participants anywhere other than the technology and the JV. Okay.
And I think you had mentioned when you first did the call that it was about 1 billion shots was your goal.
Yeah, we have 1 billion in manufacturing capacity, and if you were to ask me, like, when do I think we're able to utilize all that, assuming it's successful and we start ramping mid-year, I would bet by 2023 we're really moving those billion shots. And remember, first of all, for respiratory diseases, I think we're going to have RNA vaccines around for a long time. I mean, everybody's already talking about it. In some European countries, it's already required that you get your next booster. That means 4 shots, right? And who the hell knows where it ends, because we don't know where it ends, right? But beyond respiratory diseases, remember, we are very focused, very different price point, very different number of units, oncology and other therapies in our portfolio. And the reason why we're so fixated on getting approved for COVID is once the technology is approved for one indication, we can use that basis for safety testing. And then it's all about efficacy as we go forward with the other indications.
Can you talk about your freedom to operate in cannabinoids? Are there any, when do you expect all legal obstacles to be resolved, if ever?
I have no clue. I can tell you that we have filed a lawsuit against the CEO as well as the company for actually invasion of privacy, because I don't know why these guys would do this. They actually broke the law in the state of California. So beyond them suing us, we're suing them, and we hope like hell they spend a lot of money defending themselves because, like, I'm pretty principled. We didn't do anything wrong. We don't know anything. It's our technology, and we're going to fight this till the end. And so far it's been pretty good, and I have no way to predict the future. So leave that aside for a sec. In making cannabinoids, as of today, we have complete freedom, and we will plan on developing and making as many cannabinoids as we feel we can be advantaged in, right? Our whole notion is exactly what you've been saying. We got to be at least 50% less in cost, and cannabinoids we're making, we're definitely there. And we have to be the purest, best source of those cannabinoids. And so far, we've demonstrated that without a doubt. We've got 3 more in the pipeline that we expect to, maybe sometime later this year or early next, start to roll out additional cannabinoids. And we're focused on putting them in our brands, which we have complete freedom to do, and then marketing them through channels that we have complete freedom to market in based on the existing agreement that's currently in dispute. So the best way to answer the question is we have enough freedom with what's not in dispute that we're just going to keep operating. We hope like hell that the dispute gets settled and we have freedom in everything. so that we don't have to keep fixed on what channels and our own brands. But that's something that obviously will get figured out by the courts.
So I'm going to do a classic sell side. In the time we have remaining, I'm going to fit in 3 questions. And hopefully you can figure out how you want to hopefully they'll be easy to knock off. One is, can you talk a little bit about the relationship with Walmart and other retailers in terms of how that's transforming demand pull for your consumer business? Any
Okay.
comment? Any comments on the European expansion? And then the last one is just, is there a revenue stream for Amyris to consult on people who need help scaling up their own industrial biotech efforts?
Fantastic questions. The reason the lighting sucks right now in my room is I'm in Paris in a hotel room because I just finished an afternoon meeting with a global CEO of Sephora, right? And I did that because we have some of the best performing brands in their stores. So when you reach that, the relationship with retailers changes dramatically. It's not us talking to retailers about please carry our products. It's now evolving to how strategic can we get and how big can we get together. And you can put Walmart in that bucket. You can put other US retailers where, like for Walmart and other retailers, beauty and personal care are big, big opportunities. And they already do a lot of revenue. So we are very focused on partnering at a strategic level with some of the biggest retailers in the world of being the source of sustainable brands in their store. And that's where I see the next evolution of the model. Super exciting. Europe fits in there because obviously we have one retailer already that we're strategic with, but you could see the Europe expansion going very fast, right? UK, we're growing super rapidly in the UK. We'll do much better than we thought this year in the UK. Portugal is our next market. We have already the number one retailer in Portugal, and we start selling in Portugal in the next few days. And then we're going big with one of the biggest retailers, number one retailer in beauty across Europe. So Europe strategy is on. The thing that's not on in Europe yet is direct to consumer, and you should see direct to consumer later this year start playing for us in Europe. And then your last question, say it again to me.
It was around, can you generate a revenue stream helping other people scale up there?
Yeah, look, I'll tell you where it's happening now more than ever. It's a lot of new brands are coming to us and asking us to go from ingredient to formulation, and in some cases, actually produce for them. So I see us becoming the engine behind formulations and production of clean ingredients to products for the beauty and personal care industry. And when I say people are coming to us, from the biggest to the newest, right? So I think there's a huge opportunity there. And, it's a lot better than selling the ingredient in itself because the value add actually doubles or triples your margin on the ingredient. And our business model is simple. I'm not looking to make money as a formulator. I want to be a formulator to lock in our ingredients into their formulation. And that's what's happening. And I'd expect that to be the next big evolution of our business model.
And then the last question I'll ask is, and I promise it will be the last one, is over the last few days, we've had wildly different comments around kind of what the next big change for industrial biotech should be or will be. So, if you think about the changes that like CRISPR wrought or, PCR, what is the next thing in the pipeline that would actually make a big structural change in how you think about what your R&D is capable of? And this is the first time I've done this where there's no consensus. So I'm really curious as to what you are looking for and what you're telling your team. It would be great if they could crack and, they should burn the midnight oil trying to solve.
Yeah, look, I think the biggest breakthrough in oil was data visualization, the ability to put up on a big screen where you were going to drill and then visualize the optimal place to go. I think biology actually has that same need, but it's the pathway. The amount of data we're producing and the industry's producing. I think the next big breakthrough, and I'd be ready to contribute my data into a consortium, it's actually take all that data and start to actually model how the pathway is going to behave with each engineering change so you can become much more predictive. Because again, the end game is really not that hard to define. The end game is single design, hit your target, period. And by target, I mean an organism at scale, making it at the right cost and the right chemistry. To do single hit, man, that would be a huge breakthrough. That would basically mean a week from concept to scale.
Mm-hmm.
That would be unbelievable, right? That to get there, I think the next big step is data visualization for pathway optimization to get better and better at engineering the pathway first time out.
So basically, to get the causality right.
Exactly. Because, the problem today is you can have a million different reactions by one change, right? And we record all that, but frankly, we're like 2% of the topography, right? We're just starting. It's like Google Maps day one, right? So we have a ways to go. And the more we work as an industry, I think that's going to be the big breakthrough.
Okay, great. Well, thank you again very, very much for the time today. Thank you, everybody, for listening. If you have any follow-ups, please either contact me or the Amyris IR team. And again, thank you for staying up late and having this call. It's been a great pleasure.
My pleasure, Lawrence. Thank you so much. Appreciate your support.
Take care.